Okay, so the futures are down 1.96% and extended like it was extended last week on Friday. It could continue to sell off even more, and if it does, it's kind of hard to say if that's going to be the bottom. There could be follow through on Tuesday that keeps it moving lower, and possibly a double bottom at 13,000. The VIX is moving higher at 6.26 and getting closer to that high there at 34.05. I would expect it to try to push through that and make a new high and then pull back. And when we see the pullback, that would probably indicate that the market is going to try to retrace and move back to the 6-day moving average for another rip your face up rally either on Tuesday or Wednesday. So the futures are selling off right now, and 750R is currently in one position that's selling short Tesla. I do have Tesla in my TGIF account, and I'm not sure exactly how that's going to play out, but it did close out green on Friday. That was the only one that closed green. But we do have the Nasdaq here trading 1.9% lower, and it is extended. I think it has one more push lower by the end of Monday. It'll continue selling off into Tuesday, and then we'll get an oversold condition like we had last week, 2 weeks ago on Friday. That will be another opportunity for the market to fill the gap and then try to attempt to get back above the 6-day moving average. It could happen tomorrow, okay, if the futures gets really extended down and continues to sell off, because you can see on the Nasdaq Futures, we've got a bit of a magic mic there. And magic mic is that wick. So what I'm looking at here is that wick right here. That's the wick where we bought Tesla calls on Friday. And I think the candlestick today going into Monday and Tuesday could possibly pull back down and do a double bottom and make a lower low. So this is not a very easy market to time, especially with the gap in the S&P at 4,000. But I think it'll continue to sell off and try to attempt to break down that 13,000. This is a very dangerous level because it either breaks lower or bounces higher. And I'm not too sure if I want to try to guess which way it's going, because this is literally catching a falling knife. So I think with the futures moving lower right now by 1.9%, jumping into puts might be a little bit difficult. So it would have been better to buy puts for next week, 10 seconds into the close, but we're not in that. Any position. I don't have any positions shorting the market, and if it continues moving lower into Monday, then I think the best thing to do is look for a turnaround Tuesday, because at that point I think the futures might be a little bit extended depending on where it is on Monday at the close. If it's all the way down here Tuesday night, then look for a bounce up to 13,800. But with more news developing overseas, the geopolitical risk, this could continue to roll over and even do a double bottom and then make a lower low. If a lower low is set, then we will have to look at how the S&P is reacting, because we know that the S&P has a gap at 4,000, which is actually not too far away. It's about another 3 or 4% before the gap fills, and then that will be the potential bottom that I would say is set for the year 2022, and then we continue moving higher. Okay, so the gap in the S&P is still the big problem. We don't know when it's going to fill. Every time we think it's going to fill, it bounces pretty damn hard, and that's why timing the bottom is a cliche used by many. It's a phrase used by many traders. So here's the S&P Futures. Oops. And what I'm showing here is the S&P Futures gap, and it looks like this leg down that we're currently in might be the leg that breaks through this week. I wouldn't even be surprised if the Fed even pushes the market even lower. There's an A6 right there that's trying to trigger, and that I think there's a good chance this week this is the leg down that will get that gap fill. So this is what did I do with the Elliott Wave? So I assumed that this was one. Let me just make this bigger. So I assumed that this was wave 1, 2, 3, 4, and then this 4 right here looked like it's okay. So that's the end of it, and that low here on the candle is 4,572.75. This is 4,586. Oh wow, it is actually lower. 4,572. 4,535. So it's a low. This is wave 4, pivot 4, and this was supposed to be wave 5, but then it bounced and now rolling over. And let's see what the retracement looks like. 1, 3 like that. So it pulled back to the 2.618, bounced, staying under pivot 1, and then moved all the way down to this range here, which is not really corresponding to any fib extension level. So that cannot be wave 5. We're still in wave 5, basically, from what I see. That means wave 5 is, we're going to take out this and drop all the way down to here this week, if this is a correct waveform. I think I was looking at the Nasdaq, and its wave pattern is a little bit it's actually much more cleaner. Oh, how did I make a mistake like that? So this is wave 1, 2, 3. So the Nasdaq actually invalidated entered into pivot 1 here, and then looks like that was wave 5, but now this is wave 5. So you can see timing the bottom is very complicated. You think the bottom is here, then it rolls over and it goes down to here. You'll never catch it exactly, so managing risk is quite important. But it is important to see that this right there, this candle, which is the high showing 15,260, the low of this candle is 15,152. So it did actually enter into the wave 1 territory, which would invalidate the wave pattern in theory. So is that true? If that's true, then this is potentially wave 5, and I think it makes a higher low, like right there. Just a little lower. I don't think it'll break through under 13,000, but we won't know because the S&P has a little bit more leg room down to the downside to 4,000. Oh, yeah, I gotta share my screen. There we go. So that's the wave 1, 2, 3, 4, 5, and because wave 4 entered into wave 1 territory, there is a bit of a nuance whether this is going to continue to move lower. But in the S&P, because we have that gap that at 4,000, and it did not enter, wave 4 did not enter wave 1, there's a good chance that this thing continues to roll over all the way down to 4,000. So then we come up with an idea of what are we going to do on Monday. And because the markets are already down 1.9%, we can't, and I don't have any puts in the market or anything. I know we have short positions in other accounts trading common shares, but in terms of puts with options, I don't have anything. I only have Tesla. So long calls. And tomorrow morning, with the market being down 1.9% now, later in the night, the futures could be higher and it could be lower. We won't know until Monday, 4 o'clock a.m. Eastern time. So futures looks pretty nasty right now, 1.9%, 1.87, and it could bounce, right? And I don't know. I don't have any puts. So tomorrow morning, if you just think about it, buying puts at the open when the market's already down 1.87% is not really worth the risk, right? Even though it can move lower, we just already 2% too late. So whatever positions you have right now, you just have to manage it and then wait till Tuesday or Monday close and figure out what that daily candlestick looks like. And if it looks like it's going to sell off even more on Tuesday, then that will provide that buy the F and dip opportunity where everything gaps down like 8-9% and you buy that dip and then it rips back to the 6-day moving average for a rip your face off rally into a J Powell event. So this is what I have in mind. And actually, wow, there's like a lot of stocks are just getting hammered here. That will get hammered here on Monday. That's just brutal. So once this gap fills, that's the bottom, and it will make a complicated bottom. We have a potential inverted head and shoulders. So what that means is that this was the left shoulder, this was the head, and then it looks like it's pulling here to make the right shoulder, but that's not the case. What's actually the case is this is the left shoulder, and because we know that the S&P is going to go and fill that gap down here, it's going to bounce, and that's the head, and then it's going to bounce and then pull back, forming a right shoulder. So this is left, head, and right shoulder, and then move higher to at least try to take out that 200-day moving average. So that's what I'm thinking is going to happen. This is the left shoulder, right shoulder, head, and then it'll probably be sharp bounce to some sort of moving average, 21 or 50, pulls back and makes a little lower low, and then moves higher. So down, up, down, maybe up to the 6-day moving average, which will probably be here, lower, and then move up to the 50 or the 200-day moving average. So that's kind of what I'm seeing here. So then this is the inverted head and shoulders pattern that we're looking for. So since that gap here in the S&P is pretty legit, markets are going to continue to sell off and then bounce hard and then sell off and then bounce hard and then sell off and then bounce hard and then make a complicated bottom so that the next leg up is sustainable. So we're right here, and obviously the target is down here. Whether it gets there this week, that's a very, very tough question. It could still bounce and do a double bottom here and bounce, right, and then move lower. This is very complicated sell-off, especially with all the geopolitical risks. Okay, so that's the current candle status of the Nasdaq S&P. S&P is down 1.42, 1.8 in the Nasdaq, and whatever happens by Monday, if it's green by Monday, then we'll have to think about that whole setup again. But right now it looks like the VIX is quite strong in its trend. You can see here on the market internals, the yellow band is thickening, which means that the volatility is still pretty strong as the market continues to sell off. 2 weeks ago, you can see that when the market was selling off on Thursday going into Friday, Friday was selling off even more down to here, and that was approximately from here to the 6-day moving average. Tesla dropped down to $700 and moved from $700 on a Friday all the way up to $880 by Tuesday or Wednesday. So the Nasdaq, when it dropped all the way down here, and when we look at where the 6-day moving average is, respectively, that was a 6.78% difference from where the price was trading in the futures to where that 6-day moving average is. Okay, please pay attention to this very carefully, because you might think that buying the dip might work tomorrow, but it might not this time. Okay, so this is where the futures are right now, and this is where the projected 6-day moving average is. It's only 2.53, and that's why I think that buying calls tomorrow morning, yes, you can probably make some money on the calls, like 30 or 40%, right, on the bounce within the first 30 minutes. And then after the bounce, what's next? The VIX is still trending higher. We got geopolitical risks. We got Jay Powell speaking on interest rates. So that 2.53% is not really worthy of a buy the F and dip tomorrow morning. And even if it does bounce, okay, and you think it's going to bounce, then you have to be realistic on where it's going to stop bouncing, and that could stop bouncing right where this green dot is. That's at 13,984. Let's take a look how far that is away from the 6-day moving average. That's about 3.15%, right? So I don't know if this could be a higher low that's being priced in. And even when I'm like thinking about it, I don't even know if this is like the bottom. I don't think it will be, because my assumption here is that the Nasdaq gap, which is at 4,000, that has to fill, okay? In order for us to know when the bottom is going to fill or stop, it's going to stop where that gap is going to get filled. That's right there. Okay, I've been actually talking about this gap since last year. Actually, let's take a look at exactly when they filled that, created that gap. They created this gap back in April 2021. Holy cow. I remembered trying to catch that gap on this leg down, and see how close it came and not fill. These gaps are pretty nasty. But that gap is going to get filled, okay? And that's almost a year, 1 year gap, okay? And it's almost there. So I think this leg here, The bounce should not be bought until it gets extended. And the Fed could sell the market off all the way down on Wednesday right here. If that happens on Thursday night and the market sells off on Wednesday into Thursday and Thursday follows through and it fills the gap, that will be the best time to buy the F and dip. And because everything will be gapping down 7-8%. And then that would be a pretty good TGIF trade like we saw 2 weeks ago in Tesla when we bought it at $700. And it moved up from, it moved quite a bit since then. Okay, so this is a pretty complicated bottom. A lot of people are losing tons of money in their 401k without them even knowing it unless they're trading the SPY. But there's also going to be a group of, some groups of people that are doing well and surviving this market, getting ready to load up. But we can't load up until we understand the conditions we're working with. And right now, that S&P 4,000 gap has to get out of there in order for us to really look to say we're confident with the bottom. Because this is not the bottom at all. I don't think it is. And if we take a look at Apple, oh my God, look at this crazy Magic Mike candle. I don't even know if that's not really a Magic Mike because it's really long and hard and thick. So yeah, I'm not really too sure about what to say. But if the S&P drops down to 4,000, then look for Apple to at least retest that 200 and start breaking down through that 200 to make it down to 141. Is it a smart idea to short Apple? Man, you could see how complicated these things are. It's like you think it's shorting, then all of a sudden you get your face ripped off on the next day when it bounces on the 15th. What day is that? The 15th, February the 15th was, turnaround Tuesday. You can see that turnaround Tuesday really kicked everyone's teeth in if you were short. Let's see if I can find, like I mentioned, so some people just came in and I'm thinking about, okay, my futures are down 1.9% and I don't have any puts. So all I have is risk that I took on TGIF on Tesla. Maybe they come out with news. It's the only one that's kind of green here along with AVGO. If it doesn't work out, it doesn't work out. I got to close it out again. And then wait till the end of the day by Tuesday to see if we're going to get more follow through. Because I don't think the follow through, if you, 2 weeks ago when the market was crashing super hard on Thursday, that's this one right here. It dumped super hard. And let me see if I can get some moving averages here to help illustrate this. Yeah, when it's down this much, its moving average, the slow moving average, which is represented in red, it's way below that red line. So any additional drop, let me get rid of this volume. Any additional drop from here to here, okay, that's the oversold condition. That's when we bought the dip on Tesla, when on the $800 calls. I think, yeah, $800 calls. So you think that tomorrow, with the Nasdaq already selling off 2-3 days in a row, it could drop even lower and then bounce tonight. That's still possible. But buying puts like here at the open is you're gonna get caught, I think, because, or buying calls here, you're gonna get caught. I just, that's my opinion. So if Monday trades and the candlestick looks like this, and then it continues to sell off into Tuesday, I mean, with the FOMC this week, I would probably wait to see what the Fed does on Wednesday. And yeah, that could be anyone's best guess. Okay, so this one here, when it's selling off in the futures, it was a 6.78% drop as everyone is sleeping. Now we are about 3.15 when people will be sleeping. So that's not that extreme, and you can see that the moving averages are a little bit positioned differently, where the moving average here is a lot higher than down here. Okay, and that means that the moving average, the MACD crossover, can still drop even lower and lower because of the S&P gap. If we look at the S&P gap here, when it bounced quite a bit from the oversold condition, right? And I'm pretty sure that this MACD line was way down here, and then by the end of the day it pushed up and generated a positive gradient there, and then it moved up higher, and now we're rolling over, and if we continue to roll over, then this is going to continue to drop down here, and that could be on Tuesday or Wednesday. We got Fed speakers, FOMC this week. The Fed, the numbers are already priced in, so that actually could be the day that we should buy the dip on Wednesday morning. Okay, so Monday is already gone. If we didn't recognize that the market was going to dump 2% on Monday and you don't have any puts, it means you're not going to get into puts at the open. It's too late, right? So what does that mean? You got to wait till Tuesday and see what happens. And Tuesday could be a turnaround Tuesday and sell off even more because of this magic mic here on the S&P. There's a nice little wick there right here that can let the price just slide all the way down to here. And that would be the double bottom. And will it bounce? Well, that's the question. That's the $1 million question. Is it going to bounce, or is it going to continue selling off into Wednesday? Because of the gap. The S&P gap is at 4,000. And I don't really know. Okay, so we're literally in a position where we're catching a falling knife, and if it sells off even more tonight, then I think that's a good thing, so we can get this gap done with. So that's my conclusion for going in tomorrow. If you don't have any puts going into Monday, then the opportunity to make money on puts is not in your favor, because let's just pretend you had puts right now and you're watching the futures dump. Then tomorrow the first thing you're going to do is you're going to see your positions, like for example you bought a contract for $1 and it goes up to $2, so you're up 100%. You're going to intuitively hopefully close off half and then manage the rest into Monday's close and Tuesday's open. So buying calls at the open is not, like, I don't think that's going to work. And I've clearly shown that it's not in your best interest to do that, because when we did it last time, the displacement between the moving average, price and moving average right here is 6.6 5.6%. So you don't want to buy the dip tomorrow morning, because right now, if we look at where the price is, it's only 1.8%. So buying the dip tomorrow morning, unless you really want to buy it with like 1 or 2 contracts, you'd have to buy it with really low risk. Buying the dip tomorrow morning is not really going to be in your best interest. The market looks like it's rolling over. There's an A6 and S&P, and that rollover could go down even further and do a double bottom here where there's a magic mic right there. So the Fed could be getting ready for the market dump going into Monday, Tuesday, and Wednesday. So that was a 6%. That's 6% right here. And that was happening while we were sleeping. Right now, it's only a 1.8. But if the market keeps on dumping and it's 6%, then yeah, I think buying Monday at the open is a really good idea. Okay? So it sounds like I'm talking in contradiction, but I'm saying that if you look at where it is right now, it's only a 1.76% pullback, and it's rolling over, and it could roll, and it can continue moving lower down another 2 or 3% on Tuesday. But if the futures continues to dump and it happens to be like this, 3%, I don't know, 3% is probably not. Like down here, like 5%, then yeah, you probably want to buy the dip. And you'll look at the pre-market tomorrow, and if like Apple's down 5%, for example, then you want to buy that dip, because the average move on Tesla is around 2.5. So everyone who has puts in Apple, and for example, if Apple drops by 5% and you have puts, your puts are going to be up like 200-300%. So what are you going to do? You're obviously going to close it. And then when people are closing their puts, the thing is going to bounce, right? And try to fill that gap. So if the Nasdaq if the S&P is down, actually this is the S&P, so how much was it down here to here? So yeah, 5.59%. So if the S&P is down 5% when we wake up, then you'll look at the tickers and all the pre-markets are down 5%. Then you're going to have to buy the bounce, buy the dip with managed risk. So you don't want to go all in, but you do want to go in with at least 2 contracts. If it doesn't drop more than 5%, then you got to wait till it does do that. And that's going to happen on, I think, Tuesday or Wednesday. So we need to be careful. It looks like it's rolling over right now, and it's down like 1.88, 1.51 on the S&P. And I think what's going to happen is it's going to slide all the way down this candle, like it did last time. Whenever you get those long wicks, like this thing right here, this nice long wick, it just slowly pulls back, bounces, and then slowly pulls back. It makes another wick here and slowly pulls back. And if the news starts changing, right, and Russia starts to pull their troops back and stuff, and the market starts to embrace this thing as like an olive branch, then yeah, I think then even here it could bounce and close as a doji by the end of the day, and that could be the bottom. And the arguing point here is that we could be in an Elliott Wave 1, 2, 3, and I don't know if I want to assume this structure, because the gap here in S&P is still there. So I'm gonna have to wait till this gap gets filled before I start doing more of these Wave 1, 3, 5 structures. And they work, from time to time they do work. Like here, you get an aggressive sell-off, and then it bounces, and then it does like this Wave 1, and then a high and tight bull flag, and then you assume a 3 up to the 50-day moving average. and it doesn't work, sells off again, reset the whole count. So now we got 1, 2, and then 3. But this time the 3 is going to stop right there at the 60 minute. I think it's with J Powell this week. We'll finally see the bottom on March, and then maybe we get a pretty strong rally next week. Let me just see if we have. I think we have quad witching. Oh yeah. So typically the week after is that's the quad witching week. So typically after this week, the week with FOMC, that's going to be pretty bearish because we've seen it bearish whenever J Powell speaks. And then the week after that, because it's quad witching, that gets pretty bullish. So we should see a nice bounce starting from Friday into Friday the 18th. The third Friday of the month is the triple quad witching week. So that week will be pretty bullish. So this week, I hope that the 4,000 gap in the S&P gets taken out and we get an oversold condition by Thursday night. And if Thursday night it sells off all the way down to here, right, making a lower low, then you're going to see the MACD that's extended away from the red line, because right now it's right at the red line. It's going to continue rolling over and making a higher low. So that's a diverging pattern. So you'll get like a line like this. So for example, you can actually see a head and shoulders here on the moving average, right? And is that the right shoulder, or is this going to be the right shoulder, right? So let's just assume that that's the right shoulder because of the gap. And the path that it's been taken was like this. That's not the best color. And then it moves up. And this part right here, where when it bounces off this line and moves this way, that's going to happen Thursday morning. That's where I think the bottom will be. Okay, this is it's a complicated market. Everyone is like pretty much frustrated, right? Most people are, but you have to wait and we just got a couple more days left with the J Powell thing to get this gap filled. The gap, the sell-off on Monday, it's going to be a little bit tough because it's already down 2%. So the next opportunity to buy the dip, I guess would be, or to buy something that makes money on the puts, would be on any bounce going into Tuesday. And what I'm modeling here is an opportunity where you can just wait till the gap fills, because that will make the lower low. And if that's the low and that gets filled, then what that means is that we can start wave 1 here, and then wave 2, and then wave 3 up to the 50-day moving average. Wave 4 cannot enter into wave 1, and then 5. So that's with the assumption that this thing drops all the way down to here by Thursday morning. Thursday morning is where I think is the low. It could be Friday. So the sell-off will go all the way down here and fill that gap. And that would be the bottom. Wave 1 will start to develop 1, 2, and 3, and 4, and 5. This structure will happen next week, or starting Thursday morning. And then my other assumption is this inverted head and shoulders on this MACD is trying to find, is going to make a low, like I'm guessing the same right there, and that's where it starts moving higher like that. Right? Because that gap right here is going to have to fill, but as it fills, what you're going to see here is that MACD line, that green one, it's going to stay above the low here. So that would be a higher low. So that means if I draw that trend line, then I want that green line right here to reach this red line, and that would be technically the higher low. And I want to see that gap fill and see that MACD there touch at the same time, and then I'll be like, okay, this is the low. I think that's the low, and then that will be the beginning of wave one. So that means Thursday morning it rips higher into Friday, and then we get maybe a little bit of pullback on Monday, and then rip up every single day into Monday, Tuesday, Wednesday, Thursday. This wave 1 to 2, that could be Friday, right? If the market does a rip your face off rally on Thursday, okay, because I don't know what's going to happen on Tuesday and Wednesday because Jay Powell's in the market. You can follow somebody else. People are going to say, do this and do that because of Jay Powell. Interest rates already priced in, blah blah blah. But how do you trade like that? Right, that's pretty tough. You can trade off the algorithms. The algorithms will do a lot better than what I do. But I mean, if we're thinking about this rip your face off rally, and we know that there's a clear gap there in the S&P, and you want to be taking a little safer approach to making a lot of money, then all you really have to do is kind of condition your mindset to say, okay, Roger says that the market's going to continue moving lower. I've been with Roger for a while. He sucks at trading around FOMC. Pretty much everybody sucks at pretty much trading at FOMC. But he says that if that gap gets filled, that's the beginning of wave one. Okay, so you want to focus and hone in. If you're a person who loves buying calls and you're a big believer of TGIF, then you want to hone in on that gap fill, which Jay Powell has an excellent record of doing, selling off the markets after doing a little bit of a bounce, right? Who knows if Jay Powell on Wednesday rips the market higher on Wednesday, that could be wave one if the gap fills on Wednesday. But I don't think it will. I think it's going to sell off and fill the gap on Thursday night. The futures, because this is a futures gap. Futures gap doesn't necessarily mean the gap has to fill during the market hours. It could fill when everyone's sleeping, right? So that's what I think is going to happen. If you want to take it safe and you want to have a safe approach to the market and make a lot of money, then you want to wait till that gap gets filled, right? And if you want to day trade, then day trade with reduced risk on any bounces when it gets extended. I'll try to do a couple of day trades tomorrow morning. I'll go on voice and try to do what I can to try to buy the bounce if there's any with limited risk. My Tesla trade last week was horrible. It was the only one that was green and everything was selling off. The approach was correct, but the Tesla was just way too strong that day because of the German news. But that doesn't mean I'm not going to stop trading Tesla, right? Tesla's going to make a pretty big move, and I don't think it's really worth our time to do any exercise on Tesla charts until this S&P gap gets filled. So I'm with my experience, I know we're going to make a lot of money. We've been making a lot of money in this room for a while. And right now, I can't see us making really good trades, especially on the with FOMC coming up. The judgment is getting harder and harder because what's the market going to do when it extends a little bit, in 3% range or 4% range? It's going to rip back up, and once this gap fills, we're done. Like the bottom is in, and we're back to trying to make a double top here, or maybe a top right to around here, a triple top, right? I've seen this pattern before, top, 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 and then the market's going to be super bullish until it gets up to here again, right? And then it sells off. So, or maybe moves higher. So if you're in the camp of being conservative and looking to make some really big money, the idea here is to trade with low risk, like small position sizing all the way down to here, and then load it up when you see the futures dumping 3% on Thursday night, Thursday morning, which is like, say, 5 a.m. Futures are dumping 3%. That's when you get that same type of sell-off where we bought the dip and it rips up higher. We're waiting for that. Buying the puts and trying to time it and stuff like that. It's still, if you're good with timing and you're not too busy at work, then you can try to do it with reduced risk. But if you choose to wait for the calls, then wait for it to fill that gap, which could happen Thursday morning, and then buy that dip into Friday where it rips up, or Thursday when it rips up, and then Friday I think it pulls back on another opportunity and then rips back up higher all next week, because we got triple quad witching, which is very bullish, okay, technically, historically. So there's no point into really doing any analysis on charts right now because of the gap is the main problem. Tesla, come on, I can say Tesla's going to go to 10,000, 5,000 sometime next year, 5 years later. Amazon's going to go 5,000. Apple's going to go 250. Palantir. If you bought Palantir and you keep on buying Palantir on the dip, you're going to go broke. Okay, so don't do that. Don't follow anyone on those like crazy YouTube people. This Korean girl keeps on buying Sophie Bank. I don't know what she's doing. She's crazy. I wish I could reach out and help her, but you just don't do that. You just look at what is being presented to you in terms of evidence, and then create a plan. Like wait for that gap to fill, and then we can load up on some Tesla, because I know Tesla is probably going to try to make another run to a 52-week high. Okay, but right now it looks like a lot of the stocks are trying to make a 52-week low. Like look at Amazon's A6. Look at Amazon's gap. Look at that. And see, when it got overextended, it bounced right up to the 6-day moving average, rolling over again. So on Monday, it could go all the way down to here and then bounce on Tuesday with a turnaround Tuesday. We're not in puts on Amazon, so getting into puts on Amazon is too late. It's going to be tough because it's probably going to gap down to like 2,840. So you're way too late, and it might bounce the next day. But that gap, trying to figure out when that gap is going to get filled. Like I don't know if it's going to fill on without a 70-man TTM because it's hard to know if that's going to fill. It could fill on Wednesday. I don't know. There's a lot of gaps above. So yeah, we gotta be a little bit patient here. Like I said, if we're not in calls, if we're not in puts, then wait for this VIX to spike up to crazy levels. When it gets extended, then we look to maybe get into some positions on Monday at the close for a turnaround Tuesday. That would be my best guess on getting in a position for this sell-off. But if I want to play a little safe, I think I want to just wait till that gap gets filled here. And if it happens on a Thursday, then I think Thursday morning we get a pretty nice bounce and we can make a really good. My plan here is I want to buy weekly calls on Thursday at the open with TGIF Thursday calls, staggered position, because if I did that on Tesla, then I would have made a lot more, right? I only had Tesla for the weeklies. So I want to try to open up a staggered position on Tesla right here Thursday morning on 0 DTE and the contract that expired the week after that, so that I can hold that position until Friday. If it pulls back a little bit, then I'll use my profits from the 0 DTE to add to the TGIF trade, and then look for a move for Tesla moving up to on that wave 3 for next week. Okay, so thank you very much for your time, and I'll see everybody tomorrow morning. I'll try to do some day trades, but yeah, thank you very much for your time, and have a great day.